Hi everyone. I'll start admitting participants na po. Please turn off your video for now.
Welcome everyone to the Portfolio Manager Career Track or PJFIS 2024. Share the future, unlocking opportunities for tomorrow. We are thrilled to have you here as we dive deep into the world of finance and research. Again, if you're posting about today's sessions, don't forget to use our official hashtags, hashtag PJFIS 2024, hashtag share the future, and hashtag unlocking opportunities. Whether you're on Facebook, Twitter, Instagram, or LinkedIn, let's share our insights and experiences with a wider community. Let's get ready for an exciting day of learning and growth. I'm sure many of you are excited to learn more about what a career as a portfolio manager is really like. You're in for a treat this afternoon. For our first breakout session, we'll be hosting a panel discussion featuring seasoned portfolio managers who will answer frequently asked questions about their roles and career paths. To kick things off and guide us through this insightful discussion, our moderator for this session is a partner at PwC Philippines. Let's give a warm virtual welcome to Mr. Darwin Sariba, CFA.
Thank you, Nakamura-san, for that introduction. And happy Friday afternoon to everybody, to all the students and young professionals joining us in this breakout session on Portfolio Manager Track. Welcome. I'm really excited and pleased to introduce to you our lineup of esteemed speakers for today who will share their experiences and insights as portfolio managers. We are fortunate to be joined by 3 panelists for this session. So allow me to introduce them one by one. Our first panelist is the Senior Investment Manager at FWD Philippines. He oversees the company's internally managed funds, including the general fund and the variable unit-linked funds. Before joining FWD, he was a portfolio manager at BDO Private Bank, handling investments for high net worth individuals. He holds a degree in management engineering from the Ateneo de Manila University and is, of course, a CFA charter holder. Please join me in welcoming Mr. Benedict Andrew Algara, CFA. Hi, Andrew. Good afternoon.
Hi, everyone. Good afternoon.
Thanks, Andrew. Our second panelist is the Chief Investment Officer at Atram, where she leads the firm's investment activities across multiple asset classes. With over 14 years of experience, she has worked in both equity research and fixed income, and now oversees multi-asset strategies. She was also a member of the CFA Society Philippines Board of Trustees from 2017 to 2019. She holds a master's degree in physics from the University of the Philippines and is a CFA charter holder. Everybody, let's welcome Miss Alessandra Araulio, CFA. Hi, Sandra. Good afternoon.
Good afternoon, everyone. Thanks for having me.
Good afternoon. Finally, our third panelist is an equity fund manager at Security Bank's Trust and Asset Management Group, or TAMG. He manages the SB High Dividend Equity Fund and other accounts. He has worked as a fund manager at RCBC Trust and as a trader at UCPB Treasury. He graduated from De La Salle University with a degree in management of financial institutions and is both a CFA charter holder and a certified treasury professional. Please join me in welcoming Mr. Rafael Palma Hill, CFA. Hi, Rafi. Good afternoon.
Hi, good afternoon, everyone.
Okay, so let's jump right in. So as your moderator, my task is easy. I just have to ask questions and listen to your answers. My first question would be, we've seen that in 2022 and 2023, the stock market did not really perform well. But if you look at it right now, it's at 7.4 level. The year-to-date returns are really good. So clearly there's market volatility. My question is, as portfolio managers, how do you stay calm and make rational decisions during periods of extreme market volatility? And how do you balance the tension between, of course, the clients expecting high returns and the need to always manage risk responsibly? So I'll start with, if you don't mind, ladies first. Sandra, any thoughts on that?
I suppose over my years of experience, it boils down to communication. Having a process, having a game plan, and then communicating that to the clients and being having high fidelity towards investment mandates. We don't presume to know what's going to happen. We identify probabilities of what may happen and position accordingly. So that's something that needs to be communicated religiously with the clients. It's really part of the job as a portfolio manager. And then, of course, individually, for the temperament needs to be managed. So you have to be confident about your own process and your own discipline, and then it just plays itself out. If managing the ego is also very important. Again, who knows what's going to happen, really, right? But as far as doing what we doing our best with the information that we have on hand and updating it as we go along, that's the best we can do, and that's really the service that, at least on the buy side, that's the service that we promise our clients.
Yeah, thanks, Sandra. Can I follow up on that? Between retail investors and institutional, is there a difference in the approach when managing them, in terms of market volatility?
It's huge difference. It's like I guess for those that have some follow sports, for example, it's like asking what's the difference between running a marathon and running a 100-meter dash. Both, it's the same discipline, it's both running, but it's a different event. So it would have its characteristics. It's not to say that syempre ang retail or public funds, it's a fund, it's a pooled fund, it's a group of investors. So it's like as an aggregate, there is a behavior that needs to be taken into account versus and then iba rin yung liquidity management niyan. versus an institution. Sometimes there are many decision makers, and sometimes it works because it helps to temper the emotionality also.
Emotions and
Oo, kasi
expectations. Yeah.
matagal mag-change ng mandate, hindi naman bigla-bigla yan, 'di ba? So sometimes
Okay, okay.
they want to change because parang okay, it's not quite what they're expecting, but we remind them bakit ito yung mandate,
Mhm,
and then we
mhm,
kind of hold their hands throughout the whole
mhm,
experience. So definitely there's a difference.
mhm. Thank you, Sandra. I'll move to Andrew. So same question. How do you manage, client expectations and how do you stay rational despite market volatility?
I guess for me, at the end of the day, volatility is really part of investing. So you have to remember the objectives, so the reasons why you made certain investments, and every decision you make always has a risk involved. So investments means risk. So this doesn't mean that you don't review your decisions if things happen, but unless there really is a compelling reason that your initial assumptions are not are incorrect, or it's a really change in the economic environment, generally you just have to really ride the volatility. Especially if you're a fund manager, then you have to, you take a position because of a certain reason, certain research, or certain expectations. Then if things don't pan out because of certain things that you review, but if the initial assumptions are correct, then you really have to let it breathe a bit before you make any emotional decisions. So try to get emotion out of it.
Yeah.
Now, for
Thanks.
clients, for clients, you always have to remind them about the reasons for the investment, and there are risks in any investment. That's why, as Alessandra as well mentioned, like perhaps the thing you have to remind them is their investment policy statement, their IPS. They have a client risk profile. These are very important. You always stay within the parameters set, and since this is what was expected and talked about prior to starting the mandate. So from my experience, clients always want to get the best returns without taking any risk. And part of the job really is to
That's true.
educate them and get them to understand, that high returns equal to high risk. I get that a lot from some clients. Like, I wanted you to give me 10% return every year. But
How?
also, I don't want to lose any money at any point in time. That's a real
Yeah.
experience that I have from a client. So you got to
Yeah.
manage
Yeah.
that. There's no such thing, right?
Mhm, mhm.
Those are the things that, as Sandra mentioned, manage your clients. Really
Yeah,
very important.
yeah. Yeah. Thank you, Andrew. By the way, I'm not a portfolio manager, so I don't live the same way as you do, but I'm really curious. Does it get to you? Like, for example, if the market is down, all your clients, you're seeing red in terms of like year-to-date performance, how does it feel personally, right? Because,
Yeah.
our duty is to, right, manage their wealth. So how does it
Yeah.
feel?
Well, for me at least, I remember 2000, right? I was there, 2000, crashing March, I remember, March 15th. I started to crash. Breaker, breaker, breaker for the equity market. You're there. Deep down inside, I was thinking, this is not my money. So it's a joke there. It's not really your money, but still, you have to follow the mandate. You have to underweight and all that stuff, prudence and everything. But at the end of the day, there's an IPS. And these are the risks that your clients have. So you have to, you have to be prepared to explain, but at the end of the day, you have an IPS. There's a risk profile. So they understand the risk.
Thank you, Andrew. Now I'll move to Rafi. So same question. How do you stay calm and rational?
Yeah, no, the benefit of answering last no is just I can just agree to both of
Agree
what my
with them.
co-panelists said, no, but
Mhm,
maybe to add, to I believe communication is really the key, no, in between you and your clients,
mhm,
like what
mhm,
Sandra mentioned earlier. No? I think
mhm,
there's no way around that, no. So between
mhm,
you need to communicate well what your expectations are, and then explain why you can't meet your client's expectation, all of those things, no. Maybe um for the person, for personally, no, I think one thing that can help is really to learn more about trading psychology, the market kasi is parang bipolar yan. There are parang manic and depressive moments, right? So, and then it also influence your emotion as a fund manager, as a trader. So being aware of these behavioral finance stuff or trading psychology, will really help you as a portfolio manager, as a trader, sometimes you'll get what you aroused by your emotions, and then if you have that knowledge, you can keep yourself in check.
Thanks, Rafi. Any experience where the clients themselves were like raising their voices, yung
Yeah,
becoming irrational with their reactions also?
yeah, just to answer then, like the difference between insti and retail clients,
Retail, yeah.
insti, since it's institutionalized, parang less emotion, less attachment to the fund, so medyo
Okay,
mas
yeah,
they're more
okay.
objective
Makes
when it comes
sense.
to
Yeah, makes sense.
ano, to your performance, unlike retail or individual clients. They're more personal and emotional to their funds. I remember there's this one client wherein I outperformed the market naman on a negative year, so less
Okay,
negative yung
okay,
performance ko, but
okay.
what he just said is that you lost X amount of
It's
money,
still negative.
yes,
Okay,
and then
okay.
he asked his son, what kind of car can we buy with that kind of money?
Okay, okay, okay.
So it's really up to you to explain, and then to remind them that we are not in the short run lang naman. We're looking way into the future, so yeah. So for now, the
So
client is
charting
already
the
happy
future.
because the market is already up now, and he can buy more
Yeah.
nicer car.
Yeah, hopefully it continues. Okay, so for my next question, since most of our attendees now are students and young professionals, so looking back, what are the critical skills or experiences as students, or that students should focus on if they want to pursue a career in portfolio management? Skill set, experience, or even subjects. Okay, I'll call. Okay, so since Rafi, you said you benefit from being called last, I'll
Yeah.
call you first for this question.
All right, sige. So I guess, aside from finance, aside from economics, I think one thing that I didn't know, before, that I need to be prepared is having soft skills, like communicating with colleagues, communicating with clients, So aside from all those fancy mathematic formulas and all of that economic data, I think really communication with your colleagues and your clients is very important. Attitude is very important as well. The skills that you need in investing or being a portfolio manager can be taught, but attitude is very important. When you're in a trading room, it's like a team. You cannot be like someone who's arrogant or not likable, kasi it will bring down the performance of the whole team. So those things, there are instances wherein a candidate is very smart but has a questionable attitude, so medyo ano rin, even though perfect grades and all of that, it's often the not that an employer will go for the one who is more likable, or easy to work with.
So soft skills, personability, and teamwork. That's what you're saying. Thank you.
Yes.
Thank you, Rafi. Sandra, any thoughts on that?
um when you're a student, your job is to um establish your identity. And it's a very profound thing to say, but it's true, because um you're supposed to, it's actually a privilege to not have to mind anything else, you know establish the discipline needed to understand what your strengths are and play to those strengths, what the weaknesses are, and it's okay, everybody has weaknesses. And to it's like para siyang fundamentals talaga eh. You build your capacities, your capabilities, 'di ba? But beyond that, it's really the capacity to learn, the capacity to be adaptable in any environment. When you're in high school, it's like grades. Okay,
Yeah.
honor, whatever.
Valedictorian.
Valedictorian, whatever.
Yeah.
Honestly, ako, okay, impressive. Congratulations, you're very talented. But
Mhm. Mhm.
there are also a lot of occasions in real life where hard work beats talent. And
Mhm.
those
It's
that
true.
are resilient and who have used their younger developing years to really hone in on those skills and those core values. So again, going back, it's getting to know yourself as an individual, what your core values are, because everything else will translate. Kahit again, as Rafi said,
Mhm.
kahit gaano ka kagaling, kung
Kagaling. Yeah.
hindi ka marunong maging adaptable to your environment. You can't read a room. You are
Mhm.
arrogant.
Mhm.
You are konting madirail ka lang ng konti. Ano ka na, off ka
Mhm.
na,
Mhm.
wala.
Mhm.
You're not gonna be successful in portfolio management if
Mhm.
that's the case.
Yeah, I agree with that. Adaptability, I think, is something you really need as a portfolio manager with the market movements, with the people you
Yeah.
work with client expectations, and of course, your own welfare also. I mean, given
Mm,
everything that
mm,
could happen. Yeah.
yeah.
So thank you, Sandra. Andrew, anything to add?
Yeah, I concur with both, of course. Yeah, very teamwork and knowing yourself and being adaptable. Those are really things that you need to do. One thing I've experienced in being a portfolio manager as well, to be honest, in the Philippines right now, a lot of clients and even some of your colleagues, particularly maybe you have your sales team and such, may not be as knowledgeable. So one thing you can really work on is, communicate, right? So communicating and teaching. I do a lot of teaching. What areas you may know it, right? You may know it, but also some of your clients, some of the high network guys may know it, but a lot really don't. And even your teammates, particularly probably your sales team, your other PMs, you're good, but maybe your RMs, your sales team may not be as knowledgeable as you. So teaching them how things work will really make your life a lot easier. Actually, personally, for the past few years, that's what I've been trying to do, teaching some of our sales, because it's a bit selfish. The more I teach them, the more they know, the less they will actually bother me and bring me towards their clients and explain to their clients what happened. Because at their level, they can only manage their clients. So in terms of soft skills, that's I think very good thing you can work on. Communicate, explain things simply. Uh, Try not to yeah, we know like bond duration and all that stuff. Not everybody knows those things, right? So you got to be able to really bring it down. Like explain it to me like a 5 year like that. Getting those skills, I think, would really help you be a successful portfolio manager.
Thanks, Andrew. Um, Agree with that. Teaching, not just teaching it per se, but teaching it in a way that can be understood easily. What I got there is actually patience. So you have to be
Yes.
really patient in dealing with your colleagues, your clients, in explaining these things. Okay, thank you. Now I'll move to my next question. So we're now in the era of technology, right? So you have your generative AI or AI in general, and we also have seen some articles about using algorithm-driven trading. My question is, in your capacity now, how do you use technology at your work, and how do you balance technology with the human element in making investment decisions? So now I'll call Andrew first.
Yeah, for me, AI is a tool, right? So right now it's being rolled out even in our FWD in our office. We're rolling out this new AI tools. From what I haven't really checked it, but from what I know so far, later on we might be able to grab data easier, process data easier, even make presentations easier, right? Particularly if you're making a write up. I've tried it, using either Microsoft Copilot or ChatGPT. It really helps out in terms of finding the right word. Let's put it that way, and explaining to our client. But at the end of the way, it's still a tool, right? So there's still going to be a human element. All these things will help you analyze and make decisions. But at the end of the day, I believe a human will still have to make those decisions, right? So AI, though, honestly, I do think that some jobs may be going away, or at the very, let's say if you have a team of 20 in an investment house, maybe at some point it'll just be five because there are some things that can be automated and processed. I think that's going to happen. Perhaps even in trading side, there might be AI might be able to execute faster. But as a portfolio manager, I think we're kind of have an advantage in a sense that we still have to make a decision what to buy or what to sell. Maybe the AI can trade it for you, but somebody has to be the architect of the investment. And also, I think at the end of the day, as previously mentioned, the soft skills. I don't think clients are prepared to just listen to an AI and to tell them what's happening. I think they still want they still want human interaction, right? They have to explain to them what's happening. So that's why building those soft skills is really gonna help everyone, if you want to be a portfolio. So I think AI is a tool, but it won't completely replace the human element.
Okay, thank you, Andrew. Rafi, any thoughts on that?
Yeah, basically Andrew stole my question. My answer.
Your answer. Okay.
Yeah. So
Mhm.
again, it's a tool. It's really a tool, no. Maybe you can argue that an AI is better because it doesn't have any emotions or any biases, no. But that's also the strength of a human, no, to having intuition. So I guess
Mhm.
you cannot really rely fully on AI or on technology. You really need to work with it, no. And maybe I don't know, just to ask, have you tried calling a customer support and talking to a robot, no? Is
Mhm.
it a
Mhm.
pleasant experience? No, but we still
It's not,
prefer
yeah.
talking to
Mhm.
humans, no. So there's that. But again, these new technologies can be um helpful moving forward, no. So I'm not saying that you don't what you call this, be adaptive to change, no. We all need to
Mhm.
be receptive to that, no. So yeah, that's it. So learn these new technologies, try to figure out how to maximize them, but don't be fully reliant on
Mhm.
these things, no.
Yeah, thank you, Rafi. Sandra, I'll just add a question, but same line. Have
Sure.
you seen anything in the market, whether it's Atram or somebody else in the region or global, that's really using technology in its, full capacity for wealth management?
Yeah, in varying
Mm-hmm.
capacities, no. So we have
Mm-hmm.
the benefit of working with a lot of global partners, global
Mm-hmm.
managers like
Mm-hmm.
the likes of JP Morgan Asset Management,
Mm-hmm.
Invesco, BlackRock, and we do get a glimpse of the
Mm-hmm.
technologies that their platforms are built on.
Mm-hmm.
And I think the good thing is there's a precedent, no? Those that have
Mm-hmm.
the resources can be at the forefront of implementing globally. And then for a
Mm-hmm.
market such as ours,
Mm-hmm.
it's learning from what they've done before and figuring out how that might fit our own market. It's not to say that the sci-fi version is like end to end, robots, machines making the decisions. It's not that. It's like ano, 'di ba? The advent of autopilot for planes. Di naman you never lose a need for a pilot, but you also need a pilot that knows how to manage that new technology. um I think a lot of current managers are, the skill set will need to evolve to accommodate the new technologies, but that's where young people come in. They're natives, as you can see. For example, social media. Before, parang we didn't really give it much attention.
Mm-hmm.
Now it's like a big
Yeah.
component of marketing efforts, and
Yeah.
you're hiring social media managers, etc. And typically they're
Mm-hmm.
the young people,
Mm-hmm.
So
Yeah.
that's
Yeah.
how, you know, that's how value is created.
Mm-hmm. Yeah.
Technology is
Yeah.
really
Yeah.
something that is meant to unlock value, and
Mm-hmm.
I
Mm-hmm.
think that's the concept that we need to keep in
Yeah.
mind.
Yeah. Yeah. I agree with that. And a lot of people could earn from, social media, right? I mean, who would have thought that there would
Exactly.
come a
Mm.
time that, yeah, they could even be richer than traditional like sources of income,
Yeah.
right?
Yeah. So it's like
Yes.
I consider AI or the advent parang where we are in terms
Mhm.
of where technology is. Bilang AI pati quantum computing, for example,
Mhm.
on the hardware side, etc., cloud computing, all of the the, the data
Mhm.
that data is the new oil, diba?
Mhm.
It's the fourth industrial revolution. It's not
Mhm.
gonna take a few years. We're just at the, matagal na rin naman ng AI eh. Tagal na
Mhm.
yan, di ba? 30
True,
years ago,
true.
may AI na.
Mhm.
Pero
Mhm.
it's
Mhm.
really also the other components of technology
Mhm.
catching up, and it's
Mhm.
really parang na-unlock siya. So,
Mhm.
yeah, I think it's really exciting. It's an exciting time.
Mhm. Thank you, Sandra. I'll now move to my next question. So we have here students who may be familiar with investing or maybe not yet, or who are all just starting their journey into investments. Looking at the current market, as portfolio managers, what would be the first thing that you'd invest in if you're at that stage of your life? Stocks, bonds, crypto, a combination of these, or maybe something else? Any tips for our students? I'll call Sandra first.
Ako,
Mhm.
FX.
FX, so Forex.
Yes,
Mhm.
Forex. Because
I'll take
it's
note of that
the biggest
also.
market. It's the
Okay.
biggest market. It has the
Mhm.
most parang ways to, kumbaga, so many resources. You
Mhm.
can do
Mhm.
paper trading, you can do it efficiently, and it's fast. You can do
Mhm.
leverage. Kumbaga, it's like jumping on into the deep end without necessarily risking a lot. You don't need to put real money. You can do a dummy portfolio, no? And then the concepts and the principles that will be parang that you'll get to practice, apply to bond markets, apply to equity markets. Ano lang to getting a sense of the market lang. And then from there, and then the macro, and then it will really humble you too. Kasi
Yeah.
you can be correct and wrong at the same
Mhm.
time. So
Correct.
it's
Correct.
like even just managing yourself and getting to know what kind of portfolio manager you are, what kind of a trader you are. Ano ka ba? What do you
Mhm.
call that?
Mhm.
Yung scalper ka ba? You can apply your programming skills to automate trading system. Scalping ang tawag nun. Konting galaw lang, benta agad kasi mababa yung friction cost. But then you take it outside of that realm and apply it to, let's say, a different market or maybe a developed market, then other things come into consideration, friction costs come into consideration, etc., etc. But I think that's a really comprehensive space to get
Mhm.
started.
Mhm. To explore early. Okay, thank you. Thank you,
Mm,
Sandra.
yeah.
Rafi?
Yeah, no, my answer is a bit cheesy, no. I think
That's okay.
one investment na sure na you won't get wrong is investing on yourself. So again,
Mhm.
we are in here for a CFA society event, no. So maybe you,
Mhm.
as a
Mhm.
student, you might want to consider that first before getting into financial investments.
Mhm.
Unless you're a kid of a very a billionaire or what, no, your money right now is just too small. It won't really affect your wealth in the long run, no. So maybe investing in knowledge first will be more beneficial to you in the long run rather than diving head first to investments, no. But again, Sandra mentioned earlier, I think it is also right, no, is to try to get your feet wet little by little, no? Yeah, so invest in yourself, not just CFA, not just in terms of knowledge, physically also, no. Health is wealth, diba? So
Well-being,
yeah, your
mental health.
well-being, mental health is very important. Again, the market is bipolar. You don't want to be ano, diba? To be affected by that as well. So yeah, that's my cheesy answer to your question.
Mhm. Cheesy but highly relevant. Thank you, Rafi. Andrew?
Yeah, you know what? Alessandra got me back to the time. It's actually one of the first things I ever did right after college. There was this FX thing. And it's a very humbling experience. That's true. I will never forget that. I tried FX. made a position, took a haircut, lost everything when I came back. And that's like 30-minute period. I lost the small amount of money I had at the time placing the FX. Oh God, very humbling. That's when I realized, you know what, I really need to learn first before I do these things. You just can't just bet, without knowing or without a plan, without all that stuff. So yeah, as Ravi mentioned, you have to invest in yourself. But also, I think you should start, if you really want to invest a little bit, I know you're students, maybe you have a little savings. One thing you have to know is how much you have to know about is your risk profile. Always, every client I ever talk to, know your risk, right? Every one of us is different. Nothing is wrong. If you're a high risk guy, fine, you can invest in these equities and all that stuff. Right now, it's very easy actually nowadays. You have a lot of banks, trust department, security bank can provide you, Atram can provide you all these UITFs. So if you are a risk taker, equities could be for you. If not, then there's always going to be bonds. I think a lot of people don't like bonds, they don't make as much. But personally, I always tell clients, bond is actually a great way to invest, particularly now at this stage. Just a bit technical. Monetary policy is going to easing. I'm very, very bullish on the bond. Just buy a bond fund. The next 2 years, long duration bond fund. I think next year or two, you're going to win. It's going to be positive. And if not, it's still a very good investment in the sense that, it's not going to be as volatile. So for people, just try it and you'll see whether you're that super risk taker, try the FX thing, or if you want UITF equity thing, or you want to do bond, get your feet wet. That's what I'm going to tell these students. You're young, even if you lose 5,000, 10,000 bucks, I know it feels hurtful now. In the long run, you'll learn more by losing that. Or if you gain
that's your tuition fee to being at least more comfortable with it.
Yes.
Wala pa yatang dummy portfolios nung panahon mo, Andrew.
Ngayon meron na.
Ngayon, it's like, so easy. Check out Baby Tips. Babytips.com.
Baby tips.
That's a really good resource.
Okay, I hope our students are taking notes because I am. I also have to start that Forex. Okay, before I get to asking questions from our audience, maybe Trish or Nakamura-san, let's also ask them to chat in their questions. This question is for Sandra. I'm just curious because reading your profile, your background is master's in physics. I'm not sure what the undergrad is. I mean, for us, it's management engineering, right? Finance. It's kind of expected that we'll go this route. But for you, what's the story there? And how did you end with portfolio
Physics.
management? From
my
physics.
my undergrad is applied physics, no? So it's complex systems. I just enjoy making sense of things, understanding nature. Back then, the advice I got from my dad, who's an engineer, is to learn how to learn. Mahirap matutunan ng
Okay.
physics on your own. So that's where my professors really honed me and taught me how to learn, so that afterwards, when I really found myself interested in practical pursuits, no, my own personal economic well-being, getting a job, where do I get paid for my work, etc. When I started, I didn't even know what inflation was really. I didn't know what interest rates were. I just knew na parang, okay, the economics are not making sense. I have savings in a bank. I didn't even understand the lender borrower relationship. Pero it was I like understanding or making sense of things and how I fit into that and how I can harness, that understanding. And then I just remember talking to my friend's mom, who is an insurance agent who sold me a VUL.
Okay.
And parang at the end of the day, I got a balanced VUL. And my question was, okay, so how do you know where to put when you're supposed, or who decides where equity, whether it's equities or fixed income? And I was hearing about these things for the first time. So syempre, I mean, my friend's mom answered us as as much as she can, pero it umabot sa point na, kausapin mo na lang yung portfolio manager, hindi ko alam ang sagot. And then it just stuck to me na
Siya
parang,
nang bahala
portfolio manager,
mag-explain.
gusto kong malaman yun. Or parang, that sounds interesting for me. So yun,
Yeah,
pinursu ko lang. And then the background came in handy. You know, the learning how to learn came in handy. Yeah.
Thank you, Sandra. It seems like there's no. Oh, here we have a question here from Jillian. What's the entry level position when you are aiming of being a portfolio manager? So how do you start? Maybe I can ask Andrew.
I guess for me, my past, I started out in trust. Actually, not in the portfolio management side. So I started out actually institutional business. So I was in the sales side, client management. From there, it really got me interested in things. Actually, that's why I went to the CFA. This is the path I want to take. So I did CFA and everything. And from there, that's when I moved to portfolio management. Another path, I don't know, most other people will take will probably be an analyst. A lot of people start as a junior analyst.
Like
And you
equity
wonder,
research
equity
analyst.
analyst or any credit analyst, any of those things. That's where a lot of my colleagues started as well. And from there, then they move on to portfolio management. But I think the medyo common naman is the trust department or sell-side research. Those are the things I think more or less common for most people. Be an analyst or be a sales guy. And from there, you really learn a lot of things. Then you can prove yourself. You should prove yourself. That's why communicating with your colleagues is important because when there's an opening, they'll remember you and they'll say, you want to try this portfolio management. Then that's when you can enter. Right? So I think that's important. So just try to get in, be near the PM, and from there, hopefully things will work out in the way that you want.
Yeah, thanks, Andrew. We only have about 6 minutes. My last question would be, because this is CFA event, right? Charting the future. How did the CFA charter, or your journey in getting your CFA charter helped you not just during that time, but even up to now? Maybe that's how we should end this session. So to enlighten our students and young professionals and encourage them to take the CFA exams. I'll start with Rafi this time. Rafi?
Yeah, no. So for me, I think more than finance, more than economics, more than the accounting side, no. The CFA curriculum really helped me, like with what Sandra said, no, learn how to learn. I mean, it's a self-study program, no. So you can't blame anyone but yourself when it comes to
Exactly.
passing the exam, diba? So it really taught me how to manage my time. When I was taking the exam, I come in at the office around 5:30 to 6 a.m. to study before market opens, and then I stay because I don't want to be caught in traffic. I cannot study, diba?
Yeah,
So I stay late then to study. So it's really that, no, it's like it really helped me build my character then and my accountability to myself. Even ako may short-term goals pa when I was studying, like 25 pages a day. If you do 25 pages a day, you'll finish all the books in like 5 months or 6 months. And then you have another month for mock exams. So if ever I fail to finish 25 pages, lumalaki yung average page na kailangan ko gawin, diba? And I
per
don't want
day,
that.
yeah.
So it really helped me with that. Actually, most of the stuff I learned, especially things outside of equities, no, kasi I'm an equity guy, already forgot, no. But yung grit, yung accountability remained. So yeah, that's my answer.
Thanks, Rafi. Agree on the grit side. It's highly needed in completing the curriculum. Sandra, anything on that?
Ako ang well, obviously the competency, no? It's just basic. I mean, basic, basic, bare minimum. You want to
Grabe.
be a professional, you have to
Kay
honestly.
Sandra, basic lang daw. Basic lang to.
But I learned how to fail. I failed a few times. I failed one time for level 1. I failed twice for level 2.
Wow. Wow.
Yeah, and to carry on, having a full-time job, having a family.
Yeah.
Parang,
Yeah.
umabot ako sa point na finally pumasa akong level 2, di ba? Sabi ko, okay, level 3. Pagka bumagsak
One
pa ako
shot
dito,
lang.
one shot. I really said, okay, if I don't make it, I
Mm.
don't make it. I mean, I've
Mhm.
eh, at the end of the day, you own the knowledge, you
Mhm.
know,
That's
and
true. That's
yung,
true.
if it's my discarte that wasn't working, you really have to know how
Mhm.
to take exams too, eh.
Mhm.
Maraming
Yeah. Yeah.
components, di ba?
Yeah. Yeah.
But I had
Yeah.
to make peace with that. Buti na lang,
Mhm.
fortunately, parang I did pass and it was a
Mhm.
relief. But then,
Yeah.
the parang again, it's just like hygiene, basic hygiene. You're covering the
Mhm.
basics, and then you have something to draw upon for when it's real life. You know, applying it to your job, bringing value to clients and to the companies that you work for.
Yeah. Thanks, Sandra. That's quite a journey, I would say. Thank you
Mm-mm.
for sharing that. I hope that inspires our students. Lastly, Andrew, your journey and
Yeah,
how it
for
helped you.
it's really taught me to study. That's true. Same with Sandra. I remember when I was taking this exam, every day after work, go to Starbucks and I study 2 to 3 hours a day, 5 months straight, stuff like that. The last month, all mock tests nonstop, every day, all weekends. One of the best things that happened at that time, my now wife, my girlfriend at the time, was very understanding because it's really hard. I told her I
Yeah.
will not.
You also
We're
need
not gonna go
support.
on a date. No
Yeah.
dating for the next just months of like not really seeing each other. I told her
Mm.
I can only
Mhm.
see you. My one break is Saturday at dinner. That's the only
Grabe.
time I'll see you. Rest of the time, I'm studying nonstop. When I wake up,
Mhm.
especially the last month,
Sakripisyo
I
talaga.
wake, yeah, it's
Mhm.
sacrifice. Super
Yeah.
Yeah.
tired.
Yeah.
It's,
Yeah. Yeah.
wake up, I study buong Sunday. Math
Mhm.
lang. Tapos na. Or
Mhm.
that's it.
Mhm.
And the good thing, very understanding in the people around me and help support me. And then I
Yeah.
realized,
Yeah.
the
That's
people
also
around me
important. Yeah.
also helped me a lot in trying to achieve my goal. Because they know that that's what they wanted, and
Mhm.
that also gave me a lot of confidence, a lot of help in terms of getting here. But yeah, it's hard work and you need
Mhm.
all the support you can get. But it's worth it once you
Mhm.
achieve it.
Yeah, totally agree with that. It's worth it. Sorry for others who raised their questions. We don't have time anymore. It's actually 3 o'clock, like few seconds to 3 o'clock. Nakamura-san or Trisha, how shall we end this? Because this is the final question already.
Thank you, Ms. Alessandra Laulo, CFA, Mr. Rafael Paramazel, CFA, Mr. Benedict Andrew Argara, CFA, and Mr. Darwin Sarabay, CFA. As we're talking of appreciation, we present to you the e-certificates. Certificate of recognition, Mr. Benedict Andrew Argara, CFA, Ms. Alessandra Laulo, CFA, Mr. Rafael Paramazel, CFA, Mr. Darwin Sarabay, CFA. Let's have a quick photo of
Okay. Who's gonna count? Oh, ako na lang. 1, 2, 3.
On the other hand, there is also a path towards
Yeah, I think we're good. Thank you, everybody. I hope you learned
Thank
something
you,
today.
Thank you.
everyone.
Thank you for having us.
Thank you.
Thank you.
Thank you.
Bye. Bye. Happy weekend, everybody.
Happy
Happy
weekend.
weekend.
Our sincerest appreciation for your time and effort being here today. God bless and keep safe. All right, we take a quick 5-minute break to stretch, grab some coffee, or just refresh before diving into the second and last session for the portfolio manager career track. If you want to post about PJFIS 2024, do not forget to use the hashtags hashtag PJFIS 2024, hashtag Choose the Future, and hashtag Unlocking Opportunities. Also, a quick reminder, the variation form is available in the Zoom plenary. Completing it is part of the requirement to receive your certificate, so be sure to fill it out later. Welcome back, everyone. We had an incredible day so far, and now we are down to the final session of the Portfolio Manager career track. But don't worry, we are ending on a high note. Up next is a most attend session, a primer on the investment process, from strategy to execution. This session will walk you through the key steps involved in crafting and implementing investment strategies, helping you understand how decisions are made from the top down. So get ready for a powerful session packed with knowledge and strategies that you can apply in your own career. Our speaker is a portfolio manager and head of global investment department at Metro Bank Trust Banking Group. He has more than a decade of professional experience in trading and portfolio management. He started his career as fixed income trader at Metro Bank and has managed the asset and liability management portfolios of the Royal Bank of Canada in Toronto and of Metro Bank. He earned the Chartered Financial Analyst (CFA) designation in 2013 and has been an active member of CFA Society Philippines and CFA Society Toronto. He completed his MBA at the University of Toronto's Rodman School of Management as Bergman Scholar, top 10%, and finished his double degree major in applied economics and management of financial institutions cum laude at the La Salle University, Manila. Let's give a virtual round of applause for Mr. Christian Nero for us, CFA.
Thanks, Yuto. Can you hear me, guys?
Yes,
Yes, sir, we can hear you.
All right. So let me go ahead and share my screen. So is it possible to share my screen here? This will stop other screen sharing. Sure. Hold on. All right. So this is the primer on the investment process from strategy to execution for the Philippine Junior Finance and Investment Summit. So I was already introduced by Yuto, so I will proceed with the outline. So first, we're going to cover the investment process overview, which is a high-level view of what happens from strategy to execution to feedback. And then we'll go through the processes for each one. First is the planning step. Second is the execution step. And then third is the feedback step. Although feedback wasn't really covered as part of the topics, I thought it might be relevant to add that as well. And lastly, we'll cover very briefly what risks in investing are. So going through the investment process overview, so it's divided into 3 steps. First is the planning and strategy step, and then followed by the execution step, and lastly with the feedback step. So majority of the investment process is actually covering the planning and strategy side of it. So once you have this part, the first step, everything becomes mechanical after that. So you're like an autopilot, just following what was already planned at the beginning. And then you have the feedback mechanism to just adjust whatever changes in the requirements are. So first, on the planning or strategy step, so we will have at the top of the chart, you have the specification and quantification of investor objectives, constraints, and preferences. This also goes with the coming up of portfolio policies and strategies. And on the one below is the input on the macroeconomic environment. So you would have what relevant economic, social, political, and sector considerations you would have. And then from that backdrop, you will have or form what your capital market expectations are going to be. Once you match those ones up above and the one below, then you would have a summarized version of what your strategy will look like. So, and then on that execution part, at the middle portion, you can see it says portfolio construction and revision. So you're just there to execute whatever you planned at the start. So this involves asset allocation, portfolio optimization, security selection, and implementation and execution. And from there, you will just monitor the performance and monitor changes from the inputs above, which is the investor objectives and preferences or constraints, and then the one below, which is the market. And lastly, the feedback is when you have evaluated whether we've attained what the investors' goals are and evaluate where the performance is coming from. So to have a deep dive on each steps, first, the planning and strategy. So it's involving matching the investor-related input factors and market and economic inputs. So at a high level, this would involve three. First, identify and specify the investor's objectives and constraints. And then next is create the investment policy statement. And then third is form capital market expectations. So first, the investors' objectives and constraints. So we need to identify and specify the investor's goals and the specific constraints that he or she has. So on the left-hand side, you can see the objectives. So what characterizes an investment objective or goal? So we would have first the required objective, and then second is the desired objective. Required objectives are your critical financial requirements. So an investor will have a requirement of as to how much that do they need on a monthly basis, on a quarterly basis, or at the long term, what is the goal? Is it for retirement? Is it for buying a house? And then desired object, I'm sorry, that would form part of the desired objectives, which is something that you would like to reach, something that is not an actual cash outlay that is needed in the months to come, in the quarters to come, or the years to come. So when you say required, these are your needs, I would think, just to remember it very quickly. And then the desired would be the wants. So you have to differentiate between the two, because the required objectives are the ones that you need to service in terms of, as an investment manager, you would need to service the required objective. That's a must. As for the desired, that's something that's uncertain and you have the flexibility as to how you're going to meet it. On the right-hand side, we have the constraints. So first, if we have the objective, we have to have the risk tolerance. And this is characterized by the ability to tolerate risk and the willingness to tolerate risk. So there's a disconnect usually between the ability to take risk or ability to tolerate risk and the willingness to tolerate risk. So it's a perfect scenario when you have the two incongruence. So when you have a high ability to tolerate risk and the willingness to tolerate risk is also high, then we don't have a problem. In the same manner, that works as well. When you have a low ability to tolerate risk and low willingness to tolerate risk, it automatically decides the risk tolerance of the investor. However, it becomes an issue when one is higher and the other is lower. For instance, you have a high ability to tolerate risk. So when we say you have a high ability to tolerate risk, you don't have too much of a financial requirement because you can manage bigger swings in your investments or the investor's investments. So you have a high ability, but the willingness is very low. So meaning it the investor's portfolio can tolerate risk, but the willingness, which has something to do with the investor profile or psychological profile, or the risk, what we call risk aversion, then we'll have to manage what the investor preferences are. And most usually, we will follow first the willingness because that will necessitate or that will follow what the investor's preferences are. Um, uh, Meanwhile, when the ability to tolerate risk is low, we would compare this to somebody that has big financial requirements on a daily basis or on a monthly basis, and the willingness to tolerate risk is very high. So when you have that scenario, um, yes, it is willing to tolerate some bigger swings, but the problem is if there's a big swing or a big potential loss, then how do we service the required objectives of the client when it actually cannot able or not unable to tolerate that risk? So those are the main things that we have to consider in the constraints. Of course, there also is a factor on liquidity, which is on anticipated and unanticipated demands for cash. So these things are relevant in terms of the investments that are we gonna add into the portfolio, because if the anticipated cash requirements, we can automatically match this with investments that have specific maturities or specific dates that can be withdrawn. As for unanticipated, then that again, we will have the flexibility as to meeting those liquidity needs. Of course, we'll have to factor in transaction costs and the ability to unwind positions, unwind securities when we need to sell them just to generate cash. In the same manner for time horizon. So it's kind of similar to liquidity, but it's specific to the term of the security or term of the investor needs. So if the investor has a very short term time horizon, they need the cash in a year's time or a 2 years time, then we can't really invest the security in a long dated one. Conversely, if the investor has a constraint of a long term nature, then it might be not to the advantage of the investor if we continuously just place the investments in short-term cash or short-term investments. Another constraint would be taxes. So we have to consider whether the return that we're generating are pre or post-tax return. So the ones that we are quoting to the investors are what we call gross or net of tax. Next is the legal and regulatory environment. So these are mostly applicable for personal trust or family foundation. For personal trust, the beneficiaries are mostly family members or the ones chosen by the trustor or the one making the trust agreement. And for family foundations, these ones are usually for philanthropy and other beneficiaries that they choose in the process. Lastly, you have unique circumstances, and this would involve investor-specific requirements such as social or special purpose investing. So meaning some investors would require that you don't invest in mining stocks, or some investors would allocate to companies that have corporate social responsibility programs. So we have to take this into account when we construct the profile of the investor. So next is the creation of the investment policy statement. So we call it IPS for short. Some banks would have their own, or some banks, trust, asset managers will have their own terminology as to what they call this. But in its most basic form, it's called the investment policy statement, or IPS, and it serves as the governing document for all investment decision makings, meaning when an investment manager executes the decision, or an investment strategy and an investment decision, they refer to this document. This is their guide. This is the guide that we follow. So in the bank that I use, that I work at, we would have some form of this. Of course, it's tailor fitted according to the client needs and to the way the bank or the asset manager is set up. So at a high level, it would include a brief client description, the purpose of establishing policies and guidelines, the duties and responsibilities of parties involved, particularly those relating to fiduciary duties, communication, operational efficiency, accountability. So parties involved include the client, any investment committee, the investment manager, and the bank custodian. So the fiduciary duty is mainly putting the client's interest above all others. So that's a principle that every asset manager follows when they deal with a client. It would also involve the statement of investment goals, objectives, and constraints. So it would specifically write what the investment profile of the client is. And then it would have the schedule for review of investment performance as well as the IPS itself, meaning we would schedule updates of performance with the client every quarter, every month, every year. It depends on what the client requirements is. And at the same time, we also update the investment policy statement just to strategize on the new changes. For instance, if there's a change on the investment profile of the client or the constraint, suddenly a client got married or a client retired. So those things are factored in the investment policy statement and will matter a lot when we are implementing the allocation rates, and we'll discuss that in a bit. It would also contain performance measures and benchmarks to be used in performance evaluation. So it would identify the benchmark by which the investment manager will be evaluated. Meaning, so yes, there is a target return, and then there is a benchmark that will be the basis whether the client is performing above or below the expected or required performance. And then next is any considerations to be taken into account in developing the strategic asset allocation. Some clients would have a specific minimum or maximum on asset allocation, meaning they would want to have a specific asset allocation on equity or on fixed income that it's fixed. For instance, they want a specific allocation of 20% to fixed income always. So we'll have to take that into consideration as well. And it would also highlight the investment strategies and investment style that the investment manager will adopt. So whether it's going to be very active, indexed, or the specific investments that it will have access to. And lastly, it will have the guidelines for rebalancing the portfolio based on feedback. So some of these will also have a highlight over the next few slides. The guidelines for rebalancing the portfolio is mainly on whether we're allowed to have some tilts on the strategic asset allocation. for changes in market value. So at a high level, the investments policy would have all of these. So basically, what I did with the slide is I itemized things that are needed in each step, and you have the liberty or the chance to actually even dig deeper if you're interested at learning more about these things. So, but essentially the investment policy will have the investment strategy of the investment manager as well. So when we will have a passive manager, an active manager, and a semi-active. So passive are mainly indexers. So basically they will just mimic or track what the indexes is invested at. So there is not a lot of room for active management because it's meant to follow how the benchmark is performing. And then for active, there would be a strategic allocation to the benchmark, and then it would be allowed large to medium deviations against it, and that's what we actually call tilts in the portfolio. And then lastly, you have semi-active where you don't have big tilts, but you tilt in maybe like it would depend on how they define semi-active, but the probab the usual tolerance would be between 5 to 10% of the benchmark. So lastly, the third part of the strategy step is forming capital market expectations. So it would have the investors' expectations concerning the risk and return prospects of asset classes. So how do you go about actually forming capital market expectations? At a broad level, we would have the idea that this is how the economy is performing, and these are the assets that are gonna be attractive, and then we'll form return projections on those asset classes. So let me run through quickly about the items here. So first, specify the final set of expectations that are needed, including the time horizon to which they apply. So we form expectations because we have a requirement, we have an investor profile, and then we form expectations of what can be achieved at a specific time horizon. And then next, we research the historical record for those asset classes. So in the past 10 years, in the past 5 years, how has this asset class performed? And then we specify the method or model that will be used in the information requirements. So there are various tools and methods. I will highlight them before moving to the next slide. And then we also identify the best sources of information. So as an investment manager, you have access to sell-side research and buy-side research. When I say sell-side research, these are usually the investment banks or the capital markets groups of banks that services or provides investment advice or services to the asset managers. And when I say asset managers, this would be us, the trust, the insurance companies as well, and other institutional investors. So the sell side research, they would have a brokerage or they would have equity research analysts or fixed income research analysts. And then on the buy side, we would like in our bank, we would have we'd also have our research teams. So and then we will evaluate which one works for us. So there's also interpreting the current investment environment using the selected data and methods. So based from the research that we've found, the data that we've analyzed, then we come up with a scenario that characterizes the environment that we are in right now. And then provide the set of expectations that are needed, documenting conclusions. So then we go back to forming that expectations. And then last is monitor actual outcomes and compare them to expectations, providing feedback to improve expectation setting. Meaning, when we've set those expectations, we check for feedback whether those expectations were realized and whether we need to recalibrate the models or the research that we've prepared. So on the right side, I've provided a high-level view of the tools that we can use or the areas where we are guided in terms of forming capital market expectations. So first, we have statistical methods. These are your correlation, your time series regressions, and other statistical tools. You have discounted cash flow, which are basically the present value of your future cash flow. So we use this when we value fixed income, when we value stocks. And then another one is risk premium approach where we have a risk-free rate. So by the way, sorry, I'm just providing this as a high level because the investment process is a really comprehensive process, but you can research on each one. But I'm also highlighting them as I speak. So risk premium approach is when you have a risk-free rate, which is the minimum rate that you can get from the market, the risk-free, which is basically the government rate, and then you add the return or the premium that you will require for a riskier asset than a government benchmark. And then we would also have financial equilibrium models, which are when you match your expected return with your risk with your return, and then you do an optimization model. You can also have survey and panel methods, meaning you can form focus groups or survey the market on what their views are. And these forms as the consensus view on economic data that's going to get released, earnings that are expected to come out of the market, and investors and traders react from that. And then lastly, we also have judgment. I mean, from analyzing these things, there's also that value of based from what happened in the past, we use judgment whether there is the potential for the capital markets to perform poorly or at above expectations. So those are the things that we consider. Now we move to step 2 of the process, which is execution. So it's integrating the investment strategies with capital market expectations to select the specific assets in the portfolio. So from the book, usually creating the strategic asset allocation is part of the planning process, but some parts of it are part of execution, so I decided to include it in the execution portion. So first is you create the strategic asset allocation, and then we construct the portfolio and implement it. So let me discuss the creation of the strategic asset allocation, which includes combining the investment policy statement and the capital market expectations to determine the asset class weights. So what is that? So as we've discussed earlier, we have the investment policy statement as a guide for investing according to the investor's return requirement and risk tolerance. And then we have our expectations of which assets are going to perform. So from that, we can kind of do an optimization, or we can do it from a level that, or from a model that we have. So it all depends on the investment manager. But the essence is to have asset class weights, meaning at the end of all those matching, you will have allocation as to how much you will go to cash, how much will go to fixed income, how much will go to equity. So just itemizing each one here, I think I've already discussed the first. The second is formulate long-term capital market expectations and potential effects on asset classes. So when we say long-term capital market expectations, which markets are going to perform well? Do we expect the global markets to have better growth and earnings than the domestic market? So those are the things that we factor in, and whether that will have an effect on the asset classes, because it's possible that yes, the global scenario is better, but the assets might be overvalued already. So there might be a disconnect there as well. Third is determine the strategic asset allocation that meets the IPS objectives. So as I mentioned, this is matching your investment policy statement with the target weights for each asset classes. And then we monitor it for sure, which is the part of the periodic review, the daily monitoring of cash. And then we assess whether changes in long-term market factors warrant adjusting strategic asset allocation. I think I'll discuss this later for the feedback part. And we implement tactical asset allocation as approved in the investment policy statement. So when we say tactical, these are your short-term tilts with the strategic asset allocation. So strategic asset allocation is the core, meaning it doesn't change as much. For instance, a 40% should be close to 40%, and a tilt would be that 40% becoming a 41 or a 38%. But it should the strategic allocation should be close to 40%. So the asset mix could be it would vary depending on the available opportunities as well. So you would have domestic equity, domestic fixed income, global equity, global fixed income, alternative investments, and cash. But at a higher level, this would just be cash, equity, and then fixed income. I think my next slide will show it, which is when we already construct the portfolio and implement it. So after optimization, we construct the portfolio to determine the asset class weights and implement security selection and execution. Meaning, so first, I give an example here of how much would be allocated to cash. For instance, it's at 3%. For fixed income, it's at 40%. And for equity, it's at 57%. So this is usually what we call a 60-40 portfolio or a 40-60 portfolio, where you have 40% in fixed income and 60% in equity. But I just allocated some portion in cash because that's what realistically is the components of an investor's holdings. So for cash, the securities available, or at least the investment outlets available, are a cash account, which is your which is your savings account or your settlement account, and then you would have your time deposits, which we also consider as cash, and your money market funds. So these represent investment outlets that are easily withdrawable, easily available when we need it, and usually would have a term or tenor of less than 1 year. And then we would have fixed income, which are your bonds or government securities or corporate securities as well. These are instruments that pay you fixed coupon and has a set maturity. So we would have treasury bills, treasury notes and bonds, corporate bonds, and bond funds. Bond funds being your exchange traded fund and mutual funds, and UITF as well, which is Unit Investment Trust Fund. And then on your equity, you would have common equity, and which are your common shares, and your equity funds. Again, equity funds being your mutual fund and exchange traded fund. So when we construct the portfolio, we would have the weights. Once the weights are set, we execute and and select securities that we're going to invest into just to meet those weights. Meaning it's the time to execute the trades, to execute the trades and meet those allocation weights. So lastly, this is for feedback, which is building the portfolio is not just a set in stone strategy. So it's a dynamic and interactive process, meaning we have to listen to what the market gives us. We have to listen, or we have to watch out for any changes in the investors' objectives and constraints. So for this, we have monitoring and rebalancing the portfolio and evaluating the portfolio performance. So first, monitoring and rebalancing the portfolio. So earlier, we saw the investment framework or investment process overview, where we have the investor-related inputs, and then we have the economic and market input factors. So if there are any changes to these, then we'll go back and change the policy weights. So we will revise portfolio for any change in these input factors. And then because we revise the portfolio weights, we have to rebalance according to it, meaning we have to execute the new policy weights. So at a high level, it's any change in investment objectives, any changes in expectations, and change in policy allocations, meaning policy allocations will also change depending on the market value of the assets. Meaning, so if earlier we had 40% in fixed income and suddenly the weights of fixed income became 50%, then we have to bring that back to 40%. And bringing that back to 40% will entail selling some of those securities. And then lastly, so evaluating portfolio performance, which includes measurement and assessment of the outcomes in the investment management decision. So we have three, which is performance measurement. We need to calculate the portfolio's rate of return. This is the total, from a total return perspective, the capital gains and the interest and dividends that were accrued to the investment. Next is performance attribution, which is identifying the sources of portfolio's performance, which are like, is it from asset allocation? Is it from timing? Is it from security selection? And then performance appraisal for assessing the performance relative to the benchmark. So portfolio managers are mainly assessed from their alpha, what we call alpha, which is the excess return or the rate of return over the portfolio benchmark. So you calculate the portfolio return, and then what is the benchmark return, and any difference is called the alpha. Of course, if it's positive, that's outperformance. If it's negative, that's underperformance. So to summarize, it's from strategy to execution and then feedback. So the first two above are your strategy and execution part, but we have to take into account that we need to monitor and rebalance portfolios and evaluate whether we're achieving the investors' objectives or not. So again, from strategy, we identify and specify the investors' objectives and constraints. From there, we create the investment policy statement, which is our Bible for that specific investor. And then we form what the investment environment is going to be and how assets are going to perform according to that investment environment. So that's your forming capital market expectations. And then we create our strategic allocation. How much will be allocated to fixed income? How much will be allocated to equity? And how much will be a portion to cash? From there, we will construct what the portfolio will look like according to those policy weights, and then we will implement, which is execute the securities that are needed to fill in those weights. This involves security selection, choosing the stocks, choosing the bonds, because bonds will have different maturities, will have different issuers. Stocks, in the same manner, will have different companies and different um, ways to characterize the sector as well, like an industry, the region, and so and so. And feedback, again, is monitor and rebalance the portfolio, and lastly, evaluate portfolio performance. So I still have 3 minutes for my presentation, so let me go through quickly with the risks associated with investing. So how do we look at risk? So first, we identify the risks that are present, and then we measure those risks. And then we adjust if our risk exposure are within or outside those target ranges. So the risks involved mainly are a lot. I mean, from here I've identified 1 to 11, but on a more direct level, in terms of exposure of the investments, it's going to be your market risk, which is the risk that the value of the securities in portfolio will go down by this much. We characterize this from depending on the securities. I think on the right side, I specified there beta for equity and the duration for bond. But these are what you call interest rates risk, price risk, depending on it will depend on the security, but at a higher level or more broad level, it's called market risk, the sensitivity of the portfolio to changes in the market risk. Next is credit, which is the risk that the issuer of the bond or the borrower will not pay their obligations in time. So it's more of risk for bond investors because this is the nature of the security. And then we have liquidity risk. I think I mentioned earlier when we were discussing the constraints. It's the ability to easily sell off or convert the security into cash. So there are situations when there is no market for the security that we purchased, and we have to take that into account. So and then the other transaction costs and the bid offer spread that we have to take into account when we buy and sell securities, because this will be factored in the overall return. And then we have operate. So I'm not going to go through each one, but feel free to do a deep dive on each one. You have operational risk, model risk, settlement risk, regulatory risk, legal and country risk, tax risk, and then accounting risk, and then lastly, sovereign and political risk. For measuring risks, we have the volatility, which is the standard deviation of the portfolio. So that's the main risk for a portfolio, your volatility. So then you have tracking risk, by how much does the portfolio perform against the benchmark. Then beta is the sensitivity of the prices of stocks to the market. Duration, it's another measure of sensitivity to changes in interest rates, which affects the price of the bond portfolio. Then you have your value at risk, which is a downside measure. It specifies the minimum loss that you are exposed to for a given period of time at a certain confidence interval. And then we can also do stress testing, which is create some stress scenarios and then project how much the portfolio will be affected by those scenarios. And then in terms of managing risks, on the first side is we have risk budgeting, which is managing market risk. We apportion a certain budget as to how much risk are we going to expose to in terms of market. And then for credit risk, it's mainly just reducing our exposure when we think that the credit has deteriorated. And I think that's it for, let me just plug very quickly. I think there is a Fund Manager Association of the Philippines Trading Cup that's happening next year. It offers young individuals, aspiring fund managers, and analysts a unique opportunity to compete, grow, and learn in a real world market environment. So it is a, uh, a simulation of how the investment process is uh, implemented and done with a system where you're going to transact in. So from July 2025 to September 2025, participants will manage virtual portfolios based on live market experiences in the Philippines and thematic exchange ETFs are exchange traded funds. So if you are interested, if you're an aspiring fund manager or analyst or a finance enthusiast, and of course, most of you are students and are looking to simulate what you've learned or experience it at a more uh, uh, realistic level, then I think this is a good opportunity to try it out. Feel free to reach out to the Fund Managers Association of the Philippines, or at least from their Facebook page to check for any updates. And if you have any questions, I think I'm ready to answer them.
Thank you, Mr. Nero, for us for that insightful session. Now, to moderate the Q&A portion, may we please call on Mr. Zerg Zandwetter, AVP Portfolio Manager of CR Financial Group, Inc. The floor is yours, Mr. Zandwetter.
All right. Thank you, Nakamura-san. Good afternoon, everyone. Thank you for being here this afternoon. And Nero, thank you very much for the very comprehensive presentation that you just gave. So I'll just give a bit of time for our audience. If you guys have any questions, please type it in the chat box of our Zoom chat. And I guess maybe just to kick things off, so a question to Nero. What is really the importance of, I guess, of having such an investment process? So I think what you presented to us this afternoon is something that's very, very structured, and I guess like maybe for a beginning fund manager or aspiring fund manager, it would seem a bit maybe daunting. And I think if we look at the Philippine setting, a lot of the investment that's being done is based on haka-haka, bulong-bulong, chismis here and there, di ba? Let's buy X, Y, and Z stock. Bukas, akyat yan. So why do we need a process in the first place?
Yeah, appreciate that question. So I think the essence of having a process is really having the discipline in the investment or portfolio management process. So meaning having the discipline also makes you accountable to the process, and at the same time refer to the policy statement when the investor or the client asks you for to explain what the performance of the portfolio has been like. So it gives you a framework to work at. So I think that's how I'm gonna frame the essence of the investment process. It gives you the discipline and at the same time accountability to refer at when it needs be.
All right. Thank you. Thank you for that. My next question, I guess also as you formulate your process as a fund manager, you follow it, you make your investments. But we know that in the trading, the investing game, we're never always going to be fully right. And for sure,
Yep.
we're going to have mistakes. We're going to lose money on some positions. May I ask, as a bit of advice, what would be an appropriate process, like let's say for dealing with underperformers or losing positions?
I mean, it's part of risk management. For losing positions, we have to have a certain limit or a risk budget, as I've discussed very quickly earlier. When we have a risk budget, then we know as to how much are we gonna tolerate in terms of losses. In terms of underperformance, yes, of course, we're not always gonna outperform the market. But I think it's relevant to evaluate whether the initial assumptions that we set when we form the capital market expectations are still realistic and achievable. That might need a revisiting because we're underperforming because we didn't update our model. So that could be it. So it's that feedback part of the process.
I guess I have while waiting for questions, everyone don't be shy. Just chat in case you guys have any questions. But like I say, I guess in the fund management game, one of the things that a lot of people maybe say or I mean, a popular adage is to sell now and ask questions later. Like especially during times when we see the market all of a sudden collapsing and falling. Like how do you tie that into the process, or do you think there's any room for acting that way, or would you say that it's still better to stick to the initial process that you have, review feedback, or would there be occasions wherein nalalagdag na lahat, benta na natin yan?
I mean, if it's part of the process or the policy statement that in scenarios like this, then we have to go back to cash, then go and do it. But I think it's more a behavioral reaction in terms of uh, everything's falling. I'm just fearful of the market. I'm just gonna unload all the securities. But we have to take into account again. Go back to the strategy that we have. How long is the time horizon? Are we looking at just next week? Are we looking at just a month's time? Well, we have to take those into account when uh, we do that decision, right? Like, is the ability to take risk that high that we can tolerate that? I mean, those are the questions that you need to ask. So because uh, that selling part is like more, I would associate an emotional decision as compared with a rational decision that you're following a framework and you stick to it.
Yeah, thank you for that. So at least for our audience, I think Nero is also making a very important distinction there. I think that's as a bit of practical advice. That's also how you separate the professionals from those that are doing investing or trading as a hobby. It's the rationality. You just don't act on emotions. And I think that's why a process is also important. So I think some very good questions that we have here on the chat. So on the practical side, Dave is asking, what skills are most important for someone who wants to succeed in portfolio management?
Um, Skills, for sure, analytical skills is very important. Um, it's understanding how to form capital market expectations and understanding what the investors' goals and constraints are. So that's gonna serve you a lot when you need to account for your performance as well. So I think that's one of the most important skills in portfolio management.
Thank you for that. I'll just go through the other questions so that we could cover all of
For
them.
sure.
Timothy John is asking, what are the common mistakes a portfolio manager can commit, and how do you avoid them?
I mean, there is a lot of ways that you can uh, n- not make the correct calls, right? So because it's a market, we take what the market gives us. In terms of calls, I think as long as you follow the investment process and you committed to it and then you accounted everything that you've done, we won't count it as a mistake. It's still we follow, basically it's following the Bible, and I did what uh, the 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 policy statement told me to do, then we're okay. In terms of other mistakes, that would be, I would say, operational in nature. When you make a trade or in your worksheets you inputted a wrong assumption, I think it would boil down attention to detail so that you can avoid them. So because we're talking of money here, we're talking of client portfolios. So attention to detail is very important so that the correct assumptions are inputted in your models, and at the same time, when you decide to execute a trade and report your performance, everything is correct and accurate.
Yeah. All right. Thanks for that. Also, we only have scope for two more questions. So I'll just go through the next two ones that we have here. So Yujan is asking, how do you decide when to engage in active stock picking versus investing in index funds or ETFs?
Um, Sorry, I would have to. So because the purpose of the presentation was basically investment process strategy to execution, and the investment policy statement is the answer to this. Whether the investment style would be an active one and an indexed one, or an active, semi-active, or passive, which is indexed. But I can answer it from another lens. I would say um, from active stock picking, that involves a lot of analysis. So usually a stock would have their own dedicated equity research analyst to analyze how the company is performing today and how it will perform in the future. So I think it needs a lot of time. So if you have and you know you can devote that time to analyze a specific stock, then go for it, or just rely from the recommendation of stock analysts. That can also work. And it would again depend on your tolerance for risk, right? So this is what we call security selection, right? On the in the industry. So security selection, I would say, is more a bottoms up kind of thing where you really need to analyze the company fundamentals as against when you do an index fund or ETFs. It's more a macro play. When I say macro play, you just need to make a view on how the overall economy is going to perform, how the sector or industry is going to perform, and you don't need to do a deep dive of uh, is the management of the company gonna resign? Are there insider trading? Those kind of things. So um, it depends on your tolerance and at the same time the time that you can devote into analyzing. And if you're a top down analyst, then do your index investing. If you're bottoms up, then feel free to do your security selection and choose specific stocks.
Yeah. Thank you so much for that, Nero. So just the last question, and I guess this is a bit of, I'm just going to choose this one in particular because I think this will be appropriate to help advise our young audience for this afternoon. So last question from Dave. What steps did you take to start your career in portfolio management?
What steps did I take to? I mean, so um, how do I put it? So it wasn't really the end goal, but the choices that I made in the past led me to it slowly. It's mainly the interest in economics that brought me here. I mean, I was super interested and curious as to how the variables in the economy look like and how they change, where the money goes. So it started all with that. From that, I decided I'm only gonna apply at banks. I'm not gonna focus on anything else, and that's gonna be banks. And then after choosing or joining a bank, then what skills or how do I um, make myself more skilled and more educated in this area? And that's when I decided to take the CFA program, completed it, and then I was already in the treasury unit of a bank, so trading securities. It's more active trading. So that's uh, the part where I earlier in the session I called sell side, which is your investment banks, your sales and trading guys where that sells to the buy side, and the buy side is your portfolio management. So the natural career track actually from abroad is people or young students or young professionals would first join the sell side, the investment banks, the capital market teams for a while, have the proper training for a few years, and then join the buy side. And I guess it kind of worked for me as well. So I was in the sell side, luckily, and then also did my master's and joined afterwards the buy side, which is your portfolio management. So I would say there is no direct route to it, but as long as some bits and pieces of the picture are leading you to it, then it should um, be it will all work out in the process.
Okay. All right. Great. Thanks for that, Nero. So I think based on what we've learned from Nero and our earlier speakers, it's not necessarily like you come out of college and you already know you're going to be a fund manager. I think even probably more important than that is just to make sure you're developing the skills that could be translatable in order for you to be a fund manager, like being analytical, being curious, of course, just knowing all of your basic maths, accounting, all of these things, finance. Definitely the baseline knowledge would help. Taking the CFA for sure will help. So I guess we will wish all of you guys good luck. And with that, I'll turn over to Nakamura-san to wrap up our session.
Thank you, Mr. Naraparas and Mrs. Zanduete. As we're talking about appreciation, we present you the e-certificate. Certificate of Recognition, Mr. Christian Naraparas, CFA, Mr. Zanduete. Let's have a quick photo of
One, two, three. One, two, three.
gain our sincerest appreciation for your time and effort for being here today. God bless and keep safe.
Thank you.
Thank you.
And that's a wrap for the Portfolio Manager career track. I hope you're all feeling inspired and excited about this career path. It's full of incredible opportunities. Now we are going to take a quick 10-minute break to recharge. Use this time to grab a snack, stretch, and reflect on all the insights you've gained today. After the break, we'll be heading back to the primary session for more engaging content that you don't want to miss. We have two more fantastic sessions this afternoon: reading the markets, must-watch indicators, and LinkedIn Lock Your Profile. Both are designed to provide you with valuable insights and tools to elevate your career. So don't go too far. You can now leave this meeting room and re-enter the main webinar. You're looking for the link, it's the same one I sent your email. Enjoy break, and we'll see you back in a few minutes.